Targets, is it? You need to be hitting the toilet.
Well, I've told you a million times, wear slippers.
Slutty ass, you need a better room. Oi, Tiddly Pete, get in here.
Oh man, give it a rest, I'm watching the telly. Oh, is that for me?
It is.
Oh, love you. See that? That's how you get out of jail, boys and girls. Well, it's not really. Got to go clean the bathroom. Why? Because apparently I wasn't on target. But are you on target? Let's have a chat. Wait.
Matron, take them away.
Well, hello and a warm welcome to one and all. And if this is your first time here, I am the big fella that is always in trouble, the scruffy trader. And apparently from the beginning of this, I am incredibly scruffy. But are my charts scruffy? No, they're not. They're very methodical and they're very well thought out. And if you want to see trading in the real world, do take a second to hit that little subscribe button. Genuinely helps if you find value. Smash the like, turn on the bell icons, and for future updates, also check out my Twitter. You'll find all of the details in the description. So targets. What's that got to do with a slice of bread? And why is it important? Well, I'm a targeted trader. In other words, I work to a target. But my targets are realistic. And that is the key word here, realistic. And this whole sort of video was driven from a webinar I did last week for the 5%ers. So it's a salute to all the guys at the 5%ers. Sol, great catching up with you. And in the chat, in amongst it, somebody was asking a question, which is, when they watch me, I rarely target over 50 pips. And that's correct. But I'm also often picked up by emails and comments on my style of trading. And well, let's just put it this way. I had a conversation with one and I decided to record what they were having a go at me about. So here's a chat with a Popeye. Sorry. It's my silly schoolboy humour. But that is kind of a good metaphor as to the way people look at each other. You see, just because I trade one way doesn't mean to say it's the way you should trade. And I'm not saying what I'm doing is right. What I'm saying is it works for me. And that's it. But there's very good reasons as to why I trade the way I do. Now, firstly, I come from a business background. So I'm not looking at risk reward in the sort of way you guys are. I look at ROI, return on investment. And talking of that sort of webinar I did last week, there is going to be some further ones for the 5%ers where I go right into risk management. And within that, it's how to sort of widen your stop but reduce your exposure and increase your profitability at the same time. Now there's a mind boggler for you.
Okay, well, the mind's an amazing organ.
I've got an amazing organ.
It's capable of far more than you'd imagine.
Right again.
But it's the way the banks work. And I do it constantly and you see me do it. And it works. But I'm not only targeting my profit, I'm targeting my exit as well. And that's what this is all about. So let me jump on the whiteboard a second and I'll kind of try and explain targeting in a realistic way. Because I am sick of seeing all of this. Just put a tight stop in, 3 to 1.
They've done studies, 60% of the time it works every time.
That doesn't make sense.
No. There's not many people can time the market perfectly. You really can't. You know, so all they're doing is it's a sales hook to get you in, basically saying you're mediocre but you can still make money. No. What they're telling you is this is how gamblers work. And they'll make money. Two different things. Let's jump on the whiteboard and we'll put it into perspective. Okay guys, so targets. Simple, is it not? Well, yes, no, indifferent. Because when I'm ever speaking to somebody, it's always, well, I target 100 pips, I'll be fine. Will you? How many times do you see the market go on a straight line, 100 pips? Not very often, you know. If you're swing trading and you're looking at a single candle, which is a 4-hour or a daily, and we're talking about single candles here, guys, yes, it will move 100 pips.
Are you serious?
When you're day trading, if you're targeting 100 pips, you have to break it down into pieces. Why? Because the markets oscillate and they move about. So the first target actually comes down to yourself. And it is what type of person is applying the target. That'll scratch your head. So I'm going to put a quote on the board. Something I live by all the time. And I tell you this all the time. Because it is a cornerstone of trading. And it is, no, I, self. That's the first question you ask when you're looking to apply a target. So are you a swing or are you a day? The next part is, can the market give me what I want? You might want 100 pips, but it doesn't mean to say the market's going to give you it. Certain markets just can't do it. Simple stuff. And it's just a fact of life. But how do you know? Where can you find that out? Well, if you're breaking targets, there's one tool that will help you. And it is quite simply the ATR. And if you've never come across an ATR, you'll often find it in your brokerages amongst your indicators, and it's called the average true range. So what does that mean? Well, it tells you over an average period how far that market is expected to go, because it's based on an average of X amount of candles. Now, standard settings is fine, which is 14, so it'll look 14 candles back, and it'll work out from the open to the close what the distances are and give you an average. So what else can you do with that? Well, it's very simple. It helps you define your trading arena. So if that's your open, you open here, and it never looked back, and let's just assume for easy figures that the market has an ATR of 100. There are plenty out there that do that. You know, cable, pound USD, CAD, pound JPY, they're all in and around 100. FTSE's up 80 to 100. So there's plenty of products around that. So 100's a good benchmark. You can automatically draw in a line here and here, which is 100 that way and 100 that way. So that gives you a breadth of market. So what's that got to do with the price of bread? It tells you how far the market can actually go within the day. Because markets don't normally just open and go straight up there. Okay? They genuinely don't. That happens maybe 30% of the time. Because a market will trend roughly 30%. It's in a range the rest of the time. But that'll give you a breadth. So straight away, you can target your stops. You can say, well, I want a max stop on the other side of these, which would be like 1 ATR. Simple stuff. And then depending on where the price is, you know that's what the framework is. And this can help you tighten your stops as well as sort of manage your stops as well. I'll give you a quick example before we move on. So let's say we think this is the maximum point and the market is going to go long because you've done your analysis and you think it's going long, but you see the market drifting down and it gets down here and then plateaus out and then moves up into target. Well, that's pretty tight compared to that. So what you've done is you've let the market relax to then move forward to target. But this is where patience pays off, because if you came in on this open on this line and said, right, I want my 50 pip target, which is kind of halfway up here, and it worked its way down there first, you're sitting in a lot of pain. But if you waited, you might still get your 50 pips, but your 50 pips might be actually where you start. So all of this is extra. Patience can pay you very well by effectively waiting, but knowing what your target was in the first place. So if you want your 50 pips, what you've done is you've framed it down, tightened your stop in as well, and not gone half as much to hit your full target. Take off some of your trade, scaling it, and let the rest of it run as a bonus. Just a thought. Well, let me just wipe this down a second, and I'll keep explaining what I'm getting at. Now, in the comments, or the chat rather, from that webinar, and I'm sorry, I genuinely can't remember your name because I can't see the chat anymore, but I wrote it down. A little salute to you, sir, because I think you know who you are. What you asked was a very good question, but what I'm going to do is try and explain the way that I do it and why I do it. Okay. Now, let's just say we have our 100, all right? So that's our open, that's the max, that's the low, okay? So we know that's as high as the market will go, that's as low, and that's the open. Why do I only trade to 10 to 20 pips? Well, first of all, it doesn't take the market that much to get there. And if you've got a big enough account, that'll pay, you know. 20 pips, 5 quid a point, 100 quid, do that twice a day, 200 quid a day. That's a good wage, all right? You can listen to the Lambo boys as much as you like.
Oh, make it stop.
No, we're in this to be paid realistically, okay? So just think of that business model. I've just told you the markets very rarely go up in a straight line. They do happen, they are freak occurrences, but they are rarities. We live in the real world here. So what does the market actually do? Well, it might open here, and it might, even if it's on a trend day going straight to the top, move. But then it'll come back. It'll move. It'll come back even through this lot, down to here, up, down, move back up, retest that, then start its journey like so. Now that's assuming you're starting at say 8 AM through to say 6 PM. Could be a full day. Do you want to sit through that all day? I certainly don't. And what happens is you've entered here and you've seen the initial burst. Amazing. But you've got your TP point to think about. Why think about your TP? Well, I don't want to be stressed any more than I need to be. So that move could equal 20 pips. So that's my one trade, my one day, you know, could be like 30 pips, whatever. So if I target correctly, I could get what I need before the market comes back on itself. Or I can wait for a retest. because it often retests where it's come from. So I've seen the market go up, seen the market come down. As long as it doesn't break that level, it's then going to try and push up again. So I can get 20 pips here. That would probably take all morning to do. So that's one trade. Got two opportunities, one trade to get 20 pips. But why 20 pips from 100? You know, because surely I can get 100. Because that's what everybody tells you. Get in here, get out there. It's all well and good on a rollback chart where you know where the price has been. To do it real time, in the moment, here and now, and not know how far that market is going. That is difficult. So you come back to this bad boy here, your ATR.
No way!
So if it's 100, divide it by 3. Why 3? Because I don't want the bottom, don't want the top, I want the bit in the middle. Because I can see what's going on with that. I can use the bottom third to figure out how I'm going to get in the market. I can use the middle third to get paid, and I can use the top third to get out safely. So that gives me 33 and a third. All right. So just for easy figures, round it to 30 pips. Right. Divide that by 3. Gives me 10. So my bare minimum target is 10. But not only is it 10, it fits inside the wave. Because when the market is waving, and that's exactly what they do, they move up, they come down, they move up, they'll scream down to take out the stops, and then because think of it like a mouse trap. That is the trap to get you in, thinking you're going up here. But are you? Because the big boys need the money, so they'll drive the market down here to soak you out, then let it go on its journey. All right? You need to know the direction before you go into it, and this is why analysis and multi-time frame analysis comes into play. And if the scruffs are kicking around, do chime in the comments, and even you guys chime in the comments about how direction is important. You know, I've already worked this out before I've entered and thought about a target. Then the target just fits to what I think the wave is. Well, the wave is that. A third of the ATR. Because it'll push up, come down, push up. And you start measuring these waves out, they normally equal 3 to 4 waves. ATR can help you work that out. So that was kind of an odd way of looking at things to a degree. Right? But that's roughly how I work out my charts to target a stop, target an upper level. Grab my money on the first wave, if I can. If I miss it, I'll get it on the second. And then I just have to wait. Now, in that instance where the market was coming right down, you can just follow the price. And how do you do that? Well, just let your 15-minute candle close and ensure it's on the top side of it. So the market has to turn around and come back up, and obviously vice versa if you're going short. And then if it goes red again, move it down, move it down. As long as your conviction of bias stayed the same. Simple stuff, guys. So how else can you target? What else can you do? Well, again, it's very simple. We've talked about breadth of market using an ATR. You can also use, if you have just standard support and resistance, you know, SR lines, key levels, and you're going to enter here, you can just get a measuring tool based on your ATR and figure out where your last point of exits are, or the last point of entry are before exit. So in other words, if the market is going up, And you can see it's pushing up because your RSI is telling you it's going up. Your MACDs are telling you going up. Sitting above a moving average. It's in the upper quadrant of a Bollinger Band. And it is maybe, I don't know, 25 pips at this point. You can think to yourself, there's a fair chance the price is going to zoom into that support and resistance line, because they flush and then bounce off and come back down. Well, if you want 10 pips, you can go, right, I want a buffer zone of 10 up there. I want 10 pips down as a target point, and I've got 5 pips left to play with. So as soon as it comes over here, right, I want to get in, that's 10 pips, and I'll be out before it hits that support and resistance line. Simple stuff. Why? That's kind of what's called a tight target, because you're coming up to the level, but you've got enough room that you can grab 10 pips if you get in, but you need to know where your last point of entry is. And that's here. Because what if it only went to sort of within 5 pips of the level because you drew it wrong? You need enough room here. If you haven't, don't trade it. Wait for it to break the level, and then you can go through this process again. Support and resistance helps you trade. You can use a Bollinger Band. Now, we all know what a Bollinger Band is. It has a moving average running through the middle, an upper side, and a lower side. So how can you target there? Well, you can target a break of the moving average to the outside, up to there. Look to see if you've got 10 pips gap. If you do, great. If you don't, wait, because it means that it's sandwiching together. It's starting to come in, you know, because that's what these do. They crush like a spring and then boom out. But if that boom out and it decides it's going the other way, catch you out. So it works the same as support and resistance, but you're looking for the gap. Hope this makes sense. Basically, if I'm to tie this up, what we are looking for is one word. One simple word. Air. And now you're scratching your head, going, hold on a second here, he's lost his marbles. Well, I'll let you think about that while I have a coffee. You thought about it? Why is air the word? Because in each one of them descriptions, there is a pocket of air with nothing to stop it. There's no roadblocks, there's no barriers. So if you come in and you've got a moving average here and you've got a support and resistance level directly above it, and there's nothing between, you need that bit in between to be able to hit your target, what you've chosen. And your target has to be sensible in the first place. Because if you're swinging for 100 pips, you're going to hit support and resistance line, you're going to hit a moving average line, you're going to hit a fib line, you're going to hit a bolly. Can you see what I'm driving at? The chart can read what's going on, or I rephrase that. You can read what's going on, and if you look for decent pockets of air, how often is it 100 pips? It's not. It's more likely to be about 30. We may have a 50 pip gap, but somewhere within that, there's going to be a roadblock. That roadblock starts with moving averages, and you need to know what your moving averages are. So I'll finally finish that with what moving averages are, or the ones to look at. For roadblocks, start with your day. You want your 200, because if you stripped out all of the working days, weekends, etc., faith holidays, about 200 working days, which gives you 50 as a quarter, 20 as a working month, 5 as a working week, Monday through Friday, and 8 as a working day. They're the key moving averages to keep an eye on. And the most important one is that one. This is for pockets of air. Why is the 20 important? Well, because that's where the eyes of the world are going to be focused on, so for the working month, but it also works for a working day. I know it's not quite 24 hours, but it's pretty close to it. So that holds a lot of weight on a 1 hour chart as well as a day chart. It's a key moving average. So that's the one to keep an eye on. And then what you can do is you can use your 8 as a trigger to trade into the 20, or you can use the 5 if you're very, very aggressive and see if there's a decent gap. Now, is that not a simple way to look at targeting? In other words, plan everything you do. Nothing I do is on a whim. My charts are fully mapped and marked before I even think about what the trade is, because I want to know what the pockets of air are. When I'm on a morning, I will look for directional bias, looking at these sort of moving averages and basic indicators across a multiple arena of time frames. Daily, 4 hour, 15, 5. Looking down, filter to find one thing. The ATR divide by 3. And that gives me my target. And then from there, I can formulate a plan for the trade and execute it on the decisions that I make based on the variables that are in front of me. And that, to me, guys, is targeting. So if you're stuck, I'm very easy found. If you want to actually learn how to trade, drop in the description and you'll see all the details of the Scruffy Squad, where I go through it. Well, I just go through everything. I've done it this morning for gold next week. Full markup, why the chart's doing what it's doing and what I expect it to do. Simple stuff.
Isn't that logical?
And if you want to follow the journey, see me on the 5%ers. You'll often see my stats, and I am doing the training webinars for them. And if you're interested in that, there's a 5% discount down in the description as well. So as always, guys, trade well, risk managed, stay on target, but above all, do what you love, and the money will follow. See you all in the next one.